The U.S. Federal Reserve's move to hike interest rates for the first time since 2018 is being closely watched around the world, including here in Singapore. Well, that's because rising rates will have wider implications, not just on American businesses and consumers. On Wednesday, the Fed lifted its key rate from near zero to a range of 0.25 to 0.5% to help fight inflation. The Fed flagged further increases coming at each of its remaining 6 meetings this year. With more is Selena Ling, Head of Treasury Research and Strategy at OCBC Bank. Selena, how much of an impact does the Fed's move have on Singapore's interest rates?
Well, I think a more hawkish Fed in general would also mean that Sing interest rates would follow the US interest rates higher over time, although it will not be a one-for-one type of correlation. But it is actually very interesting to note that, the Fed has been lagging behind market expectations. So the futures market already had been pricing in the possibility of the Fed hiking 7 times this year. So to a large extent, I think the Fed is playing catch up. So what we have seen in the overnight moves essentially is that US Treasury yields are sharply higher in the wake of the FOMC meeting. But if you look at the market action on the Sing side, actually SGS bond yields are actually lower. I think to a certain extent, market players are trying to anticipate what would be the response from the Monetary Authority of Singapore in light of the FOMC's latest interest rate trajectory. So as you know, the MAS actually slightly steepened the Sing-Near slope in October last year, and they did an off-cycle tightening in January this year. So there is another scheduled meeting coming up fairly shortly in early to mid-April, which is less than a month away. And I think market is really trying to anticipate what would be the MAS's next move, which is, of course, leaning towards the possibility of another tightening move as well.
Selena, I want to get you to elaborate on the MAS's possible response later on. But first, this latest move by the US Federal Reserve, it will no doubt affect business and consumer spending in the US. But what are the implications for demand for goods and services from Singapore?
Well, I think if you look in terms of the market reaction, it tells you quite a fair bit about what has been already priced in. So higher interest rates from the Fed in light of the multi-year high in terms of US inflationary prints is quite clearly they are playing catch up. I think in terms of how it would actually impact the US economy, especially on the growth front. So Fed Chair Powell actually sounded hawkish but also upbeat at the same time. He actually opined that, this current Russia-Ukraine tensions would not have a very significant impact on US growth. Hence, the central bank is focusing more on combating inflation rather than trying to support growth. In terms of the impact on the Singapore economy and also in terms of demand for both consumers and also business confidence, I think we have to look at it as a glass half full in the sense that we are seeing price inflation across a lot of goods and services rising quite sharply. Some of it is due to, of course, global supply chain problems. And some of it, of course, because of the disruptions that we see due to the fact that, Russia and Ukraine are at odds with each other. I think going forward, we do expect that higher inflation is here to stay in the short term. And this would actually mean that the MAS would have also to stay on a hawkish path. So we don't think that this in itself should derail business confidence or consumer spending for that matter. But, geopolitical uncertainties are typically very, very hard to predict. So we are a little bit, careful about the potential downside risks if central banks, for instance, like the Fed, actually become overzealous and overdoes the monetary tightening.
Well, Selena, let's go back to what you earlier said about, MAS's response. As you know, Singapore is also battling rising inflation. So what do you expect will come out of the Monetary Authority of Singapore's upcoming policy meeting in April?
I think our baseline scenario really is that the MAS will continue to tighten for the third time running in the April scheduled meeting. Of course, the form of the tightening and the magnitude of the tightening is actually fairly dependent on how the data, especially on the inflation front, pans out, in the coming weeks and months. But given that geopolitical uncertainties really have contributed to, commodity prices and food inflation running a little bit hotter than what was initially expected, I think the pressure actually is on for central banks, including the MAS, to lean a bit more on the hawkish side. Of course, if they do steepen the slope for the senior trade-weighted basket again, there is a possibility that they can do a little bit more in terms of the steepening compared to the last two tightening moves. And I think this in turn will actually help to suppress some of the imported inflation that's coming into the Singapore economy, and also allow Sing interest rates a little bit of breathing space so that they don't actually have to follow the US interest rates like for like.